Fire insurance. It's that line item you see on your mortgage statement, or maybe just a box you tick when you're getting a loan. But what is it really? Well, at its core, it's a promise of financial safety if disaster strikes. But how does that promise actually work when you need it most? Let's break it all down.
Let's just start with the most important question right off the bat. If the absolute worst happened, a fire took your home, your business, everything, would you be able to recover financially? And we're not just talking about losing stuff, we're talking about the crushing financial weight that comes after. This is the whole reason fire insurance even exists. So, a fire insurance policy is basically a contract, a deal. You pay a fee, called a premium, and in exchange, the insurance company promises to help you get back on your feet if a fire or some other disaster on the list causes a financial loss. It's not about making a profit. It's a contract designed to make you whole again.
Now, that promise, it's not a blank check. It's actually built on a really solid foundation of principles. You can think of them as the 6 golden rules of the game. And understanding these is absolutely key to understanding your policy and what's expected from both you and your insurer.
Okay, so here they are, the 6 core principles. And I know they might look a little intimidating, maybe a bit like legal jargon, but trust me, each one of these is a crucial building block that makes the whole system of insurance work fairly for everyone. So let's start with the big one.
First up, we have utmost good faith. This is basically the principle of radical honesty. When you're applying for insurance, you have a duty, a responsibility to tell the insurer everything that matters about the property you're insuring. It's a two-way street, for sure, but the responsibility really starts with you, because hey, you know your property better than anyone. Next is insurable interest. This one's actually pretty simple. It just means you can only insure something if you would suffer a direct financial loss if it were destroyed. So you have an insurable interest in your own house, but you can't take out a fire policy on your neighbor's house. This is what separates an insurance policy from just a gamble.
Okay, this next one, the principle of indemnity, is so important to get. Insurance is not a lottery ticket. Its whole purpose is to hit a financial reset button, putting you back in the same spot you were in right before the loss happened. The goal is to make you whole, not to make you rich.
And the last 3 principles? They all work together to reinforce this idea of fairness. Proximate cause just means the fire itself has to be the main direct reason for the damage. Contribution means that if you cleverly have 2 policies, you can't claim the full loss from both of them and double your money. And subrogation is pretty interesting. It lets your insurer go after the person who caused the fire to get their money back, which actually helps keep premiums down for all of us. Okay, so we've got the rules of the game down. Now let's crack open standard policy and see what's actually inside. This is where we get into the nitty-gritty of what you're protected against, and just as importantly, what you aren't.
Every policy has 2 sides to it. On one side, you've got the perils that are covered, the usual suspects like fire, lightning, storms. But you have to pay just as much attention to the exclusions on the other side. You'll notice that huge events like war or nuclear risks are out. And probably goes without saying, but any fire you start on purpose, yeah, that's never ever covered. Now check this out. Here's a fascinating little nugget from the fine print. The policy usually excludes damage to an item from its own spontaneous combustion. Think about a haystack or a pile of oily rags in a hot garage that just heat up and burst into flames all by themselves. The policy says that first haystack isn't covered. But if that fire then spreads and burns down the whole barn, the damage to the barn is covered. It's a subtle little detail, but it shows you how specific these policies can be. The thing is, a standard policy is just the foundation. The real power comes from being able to customize it. You can use all sorts of add-on covers to build a policy that fits your exact needs and protects you from your specific risks, whether that's worrying about forest fires or needing extra cash to cover debris removal. So you can really build on that foundation. For instance, you can add coverage for risks like earthquakes or forest fires. You can make sure you're covered for the extra cost of an architect or for clearing away debris. You can even get coverage for lost rent if a fire forces your tenants to move out. You can even add a cover for that spontaneous combustion risk we just talked about. It's all about making the policy fit your life, not the other way around. So you've done your homework, you understand the principles, you've customized your policy, and then it happens, a fire. Now comes the moment of truth. You need to make a claim. And this, right here, is where one of the most common and most financially painful mistakes is made. Because everything we've talked about, it all comes down to this one single question.
It's not just about having insurance, it's about having the right amount of insurance. And if you get this wrong, that promise we talked about can get a whole lot weaker. This huge mistake has a name. It's called underinsurance. It happens when the amount you insured your property for, that's called the sum insured, is less than what the property is actually worth. And when that happens, a special clause in your policy called the pro rata average condition kicks in, and believe me, it can have a massive impact on how much you get paid.
Let's just walk through a scenario with some easy numbers. Let's say your property is actually worth 40,000 rupees, but maybe to save a few bucks on the premium, you only insured it for 30,000. Then a fire causes a partial loss of 16,000 rupees. Now, you might be thinking, hey, my loss is 16,000, I'm insured for 30,000, so I'm totally covered, right? Well, not so fast.
See, the insurer uses a very specific formula here. They take the amount you insured for, in this case, 30,000, and they divide it by the actual value of the property, which is 40,000. Then they multiplied that result by the amount of your loss. So 30,000 divided by 40,000 is 3/4, or 75%.
And what does that mean? It means your claim payment is only 12,000 rupees. Your actual loss was 16,000, but because you were underinsured, you're suddenly facing a 4,000 rupee shortfall that has to come directly out of your own pocket.
So why on earth does this happen? The policy wording itself gives us the answer. It literally says that by insuring for less than the full value, the insured shall be considered as being his own insurer for the difference. In other words, you effectively agreed to take on part of the risk yourself. Let's put it as simply as possible. You only paid a premium to cover 75% of the property's value. So the insurance company is only going to pay for 75% of your loss, no matter how big or small that loss is. By underinsuring, you basically became a partner in the risk. So you have to be a partner in the loss, too.
So, after all that, what are the big things to walk away with? First, honesty with your insurer is everything. That's utmost good faith. Second, always remember insurance is there to make you whole, not to make you rich. That's indemnity. Third, and this is the big one, insuring your property for its full current value is absolutely critical to avoid that underinsurance trap. And finally, really take the time to read the fine print, understand what's excluded, and add the extra coverage you actually need.
At the end of the day, your insurance policy is a promise of financial recovery. But just like any contract, its real power is buried in the details. So the real question I want to leave you with is this. Do you know exactly what your policy is promising you? Now might be the perfect time to pull it out and find out.